All right, our next major topic in the CFA Level 1 program curriculum, now on portfolio management. Study sessions. We have two study sessions, study session 12 and 13, portfolio management 1 and 2. Topic learning outcomes. The candidate should be able to explain and demonstrate the use of fundamentals of portfolio and risk management, including return and risk management and portfolio planning and construction. Okay. Portfolio management, that's our next section. Study session 12, portfolio management 1. This study session introduces the concept of portfolio approach to investments, the needs of individuals and institutional investors to examine, are each examined along with the range of available investment solutions. The three main steps in the portfolio management process, planning, execution, and feedback are outlined. Common measures of portfolio risk and return. An introduction of modern portfolio array, the quantitative framework of assets, pricing, and portfolio sections then follows. Reading assignments, reading 38 about portfolio management and overview, reading 39 about portfolio risk and return, part 1, and reading 40 about portfolio risk and return, part 2. Reading 38, portfolio management and overview. Learning outcomes, the candidate should be able to describe the portfolio approach to investing, describe types of investors and distinctive characteristics and needs of each, describe defined contributions and defined benefit pension plans, describe the steps in the portfolio management process, describe mutual funds and compare them with other pooled investment products. Introduction. In this reading, we explain why the portfolio approach is important to all types of investors in achieving their financial goals. We compare the financial needs to different types of individuals and institutional investors. After we outline the steps in the portfolio management process, we compare and contrast the types of investment management products that are available to investors and how they apply to the portfolio approach. The portfolio perspective in investing. One of the biggest challenges faced by individuals and institutions is to decide how to invest for future needs. For individuals, the goal might be to fund retirement needs. For such institutions as insurance companies, the goal is to fund future liabilities in the form of insurance claims, whereas endowments seek to provide income to meet an ongoing need of such institutions as universities. Regardless of the ultimate goal, all face the same set of challenges that extend beyond just the choice of what asset classes are to invest in. They ultimately center on formulating basic principles that determine how to think about investing. One important question is, should we invest in individual securities, evaluating each in isolation, or should we take a portfolio approach? By portfolio approach, we mean evaluating individual securities in relation to their contribution to the investment characteristics of the whole portfolio. In the following section, we illustrate a number of reasons why a diversified portfolio perspective is important. Portfolio diversification, avoiding disaster. Portfolio diversification helps investors avoid disastrous investment outcomes. This benefit is most convincingly illustrated by examining what may happen when individuals may not diversify. We are usually not able to observe how individuals manage their personal investments. However, in the case of U.S. 401ks, individuals' retirement portfolios, it is possible to see the results of individual investment decisions when we examine their retirement portfolios. We find that some individual participants make suboptimal investment decisions. During the 1990s, Enron Corporation was one of the most admired corporations in the U.S. Position in Enron shares returned to over 27% per year from 1990 to September 2000, compared to 13% of the S&P 500 index in the same time period. Okay. Wow, that's a massive spike. What happened in 1999? During this time period, thousands of Enron employees participated in the company's 401k retirement plan. The plan allowed employees to set aside some of their earnings in tax-deferred accounts. Enron participated by matching their employer contributions. Enron made the match by depositing required amounts in the form of Enron shares. Enron restricted the sale of its contributed shares until the employees turned 50 years old. In January 2001, the employees' 401k retirement accounts were valued over $2 billion US dollars, of which 1.3 billion or 62% was Enron shares. Although Enron restricted the sales of shares and contributed less than 150 million of the total of the 1.3 billion of shares had this restriction, the implication was that Enron employees continued to hold large amounts of Enron shares even though they were free to sell them and invest to proceed in other assets. A typical individual was Roger Bruce, a 67-year-old Enron retiree who had held all of his $2 million US dollars retirement funds in Enron shares. Unlike most stories, this one does not have a happy ending. Between January 1st and 2001 and January of 2002, Enron shares fell from about $90 per share to zero. Damn, look at that fall. Employees and retirees who had invested all or most of their retirement savings in Enron shares, just like Mr. Bruce, experienced financial ruin. The hard lesson that Enron employees had learned from this experience was to not put all your eggs in one basket. Unfortunately, the typical Enron employee did not have most of his eggs in one basket. Most employees' wages and financial assets were dependent on Enron's continued viability. Hence, any financial distress in Enron would have a material impact on the employees' financial health. The bankruptcy of Enron resulted in the closing of its operations, the dismissal of thousands of employees, and its shares becomes worthless. Hence, the failure of Enron was disastrous to the typical Enron employee. Enron employees were not the only ones to be victims of overinvestment in a single company's shares. Another form of pension arrangement in many corporations in this defined contribution plan, in which the employer makes periodic cash contributions to a retirement fund managed by the employer themselves instead of guaranteeing a certain pension at retirement. In the defined contribution retirement plans at Owens Corning, Northern Telecom, Corning, and ADC Telecommunications, employees all held more than 25% of their assets in the company's shares during a time in which shares prices of the companies fell by almost 90%. The good news is the story is that the employees participating in employer matching 401k plans since 2001 has significantly reduced their holdings of the employer's shares. Thus, by taking a diversified portfolio approach, investors can spread away some of the risk. All rational investors are concerned about the risk-return trade-off of their investments. The portfolio approach provides investors with a way to reduce the risk associated with their wealth without necessarily decreasing their expected rate of return. Portfolio reduced risk in addition to avoiding a potentially disaster association with overinvesting in a single security. Portfolios also generally offer equivalent expected returns with lower overall volatility of returns as represented by a measure such as standard deviation. Consider this a simple sample. Suppose you wish to make an investment in companies listed on the Hong Kong Stock Exchange, and you start with a sample of 5 companies. The cumulative returns of the 5 companies from Q2 2004 through Q2 2008 are shown in Exhibit 3. The individual quarterly returns for each of the 5 shares are shown in Exhibit 4. The annualized mean and annualized standard deviation for each are also shown. Suppose you want to invest in one of these 5 securities next year. There is a wide variety of risk-return trade-offs for the 5 shares selected. If you believe that the future will replicate the past, then choosing lie and phone will be a good choice. For the prior 4 years, Lie and Phone provided the best trade-off between return and risk. In other words, it provided the most return per unit of risk. However, if there is no reason to believe that the future will replicate the past, it is most likely that the risk and return on the one security selected will be more likely to select one randomly. When we randomly select one security each quarter, we found that the average annualized return was 15.1%. And the average annualized standard deviation was 24.9%, which would now become your expected return and standard deviation, respectively. Alternatively, you can invest in an equally weighted portfolio of the 5 shares, which means that you would invest in some same dollar amount in each security for each quarter. The quarterly returns on an equally weighted portfolio are just the average of the returns of the individual shares as reported in Exhibit 4. The equally weighted portfolio has an average return of 15.1% and a standard deviation of 17.9%. As expected, the equally weighted portfolio's returns is the same as the returns in the randomly selected security. However, the same does not hold true for the portfolio standard deviation. That is, the standard deviation of an equally weighted portfolio is not simply the average of the standard deviation of individual shares. In a more advanced reading, we will demonstrate in greater mathematical detail how such a portfolio offers a lower standard deviation of return than the average of its individual component due to the correlation of interactions between the individual securities. Because the mean return is the same, a simple measure of the value of diversification is calculated as the ratio of standard deviation of the equally weighted portfolio to the standard deviation of the randomly selected security. The ratio may be referred to as the diversification ratio. In this case, the equally weighted portfolio's standard deviation is approximately 71% of that of the security selected at random. The diversification ratio of the portfolio's standard deviation to the individual's asset standard deviation measures the risk reduction benefit of a simple portfolio construction method. Equal weighting, even though the companies were chosen from a similar industry grouping, we see significant risk reduction, and even greater portfolio effect could have been realized if we had chosen companies from completely different industries. This example illustrates one of the critical ideas about portfolios affect risk more than returns. In the prior section, portfolios help avoid the effect of downside risk associated with investing in a single company's shares. In this section, we extend the notion of risk reduction through portfolios to illustrate why individuals and institutions should hold portfolios. Portfolio composition matters for the risk-return trade-off. In the previous section, we compared an equally weighted portfolio to the selection of a single security. In this section, we examine additional combinations of the same set of shares and observe the trade-off between portfolio volatility of return and expected return. If we select the portfolio with the best combinations of risk and return, we produce the set of portfolios shown in Exhibit 5. So we can sort of see a trend. In addition to illustrating that the diversified portfolio approach reduces risks, Exhibit 5 also shows that the companies and portfolios matters. For example, an equally weighted portfolio, 20% of the portfolio of each security. Let me drink my apple juice real fast first. Of the 5 shares has an expected return of 15.1% and a standard deviation of 17.9%. Alternatively, a portfolio with 25% Yuan Industrial Holdings, 3% on Cathay Pacific, 52% on Hutchinson Whampoa, 20% in Lion Phone, and 0% in Costco Pacific produces a portfolio with an expected return of 15.1% and a diverse standard deviation of 15.6%. Compared with this simple equally weighted portfolio, this provides an improved trade-off between risk and return because a lower risk was achieved at the same level of return. Portfolios not necessary downside protection. A major reason that portfolios can effectively reduce risks in a combining securities whose returns do not move together provide diversification. Sometimes a subset of asset will go up in value at the same time that another will go down in value. The fact that these may offset each other creates the potential diversification benefit we attribute to portfolios. However, an important issue is that the co-movement or correlation patterns of the securities returns in a portfolio can change in a manner unfavorable to the investors. We use historical return data from a set of global indexes to show the impact of changing co-movement patterns. When we examine the returns of a set of global equity indexes over the last 15 years, we observe a reduction in the diversification benefit due to change in a pattern of co-movement of returns. Exhibit 6 and 7 shows the cumulative returns for a set of 5 global indexes for 2 different time periods. comparing the first time period of Q4 1993 through Q3 2000. And with the last period of Q1 2006 through Q1 2009, we show that the degree of which these global equities index move together has increased over time. The latter part of the second time period from Q4 2007 to Q1 2009 was a period of dramatic decline in global share prices. Exhibit 8 shows the mean annual returns and standard deviation of returns on the time period. During a period of, so this is just interpreting the data. Okay. Portfolios, the emergence of modern portfolio theory. The concept of diversification has been around for a long time and has a great deal of intuitive appeal. However, the actual theory underlying the basic concept and its application to investment only emerges in 1952 with the publication of the Harry Markowitz classic article on portfolio selection. The article provides a foundation for which is known as modern portfolio theory, or MPT. The main conclusion of MPT is that investors should not only hold portfolios but should also factor on how individual securities in a portfolio are related to one another. In addition to the diversification benefit of portfolios to investors, the work of William Sharpe of 1964, John Lintner of 1965, and Jack Traynor of 1961 demonstrates the role of the portfolio plays in determining the appropriate individual asset risk premium. According to capital market theory, the priced risk of an individual security is affected by holding it in a well-diversified portfolio. The early research provided the insight that an asset's risk should be measured in relation to the remaining systematic or non-diversifiable risk, which should be the only risk that affects the asset's price. This view of risk is the basis for the capital asset pricing model, or CAPM, which is discussed in greater detail in other readings, although MPT has limitations. The concepts and intuitions illustrated in the theory continues to be the foundation of knowledge for portfolio management. Investment clients, portfolio managers, and employees can contracted by a wide variety of investment clients. We could group the clients into categories based on their distinctive characteristics and needs. Our initial distinctions is between the management of a private wealth of individual investors and investment management for institutional investors. Individual investors have a variety of motives for investing and constructing portfolios. Short-term goals can include providing for children's education, saving for a major purchase, such as a vehicle or a house, or starting a business. The retirement goal, investing to provide for an income in retirement, is a major part of investment planning for most individuals. Many employees of public and private companies invest for retirement through the defined contribution pension plan, a DC plan. A DC plan is a pension plan in which contributions rather than benefits are specified, such as a 401k plan in the U.S., groups personal pension schemes in the United Kingdom, and superannuation plans in Australia. Individuals will invest parts of their wages while working, expected to draw on accumulated funds to provide income during retirement or to transfer some of their wealth to their heirs. The key to DC plans is the employees accept the investment risk and is responsible to ensuring that there are enough funds in the plan to meet their needs upon retirement. Some individuals will be investing for growth and will therefore seek assets that have the potential of capital gains. Others, such as retirees, may need to draw an income from their assets and may therefore choose to invest in fixed incomes and dividend-paying shares. The investment needs of individuals will depend on their broader financial circumstances, such as their employment prospects and whether or not they own their own residence. They may also need to consider such issues as building up a cash reserve and the purchase of appropriate insurance policies before undertaking long-term investments. Institutional investors. There are many different types of institutional investors. Examples include defined benefit pension plans, university endowments, charitable foundations, banks, insurance companies, investment companies, and sovereign wealth funds. Institutional investors are major participants in the investment markets. Exhibit 10 shows the relative size and growth of the key categories of organizations of economic cooperations of developed countries, the OECD countries. Investment funds are the largest category, with insurance companies and pension funds not far behind. The relative importance of these categories does not vary significantly across the individual OECD countries. The defined benefit pension plans, the DB plans, an employer has an obligation to pay a certain annual amount to its employees when they retire. In other words, the future benefit is defined because the DB plan requires that plan sponsors to specify the obligations stated in terms of the retirement income benefit owned to participants. DB plans need to invest in assets that will provide cash flows that match the timing of future needs. To invest in the assets that will provide cash flows that match the timing of the future pension payments. Plans are committed to paying pensions to members, and the assets of these plans are there to fund these payments. Plan managers need to ensure that significant assets will be available to pay pension benefits as they come due. The plan may have an indefinitely long time horizon. If new plan members are being admitted to a finite time horizon, if the plan has been closed to new members, even a plan closed to new members may still have a time horizon of 70 to 80 years. For example, plan member age 25 may not retire for another 40 years and may live 30 years in retirement. Hence, the pension plan could be considered long-term investors. In some cases, a plan manager attempts to match the fund's assets to its liabilities by, for example, investing in bonds that will produce cash flows corresponding to expected future pension payments, and be many different investment philosophies for pension plans depending on fund status and other variables. Endowment and foundations. University endowments are established to provide continuing financial support to a university and its students, e.g. Scholarship endowments vary in size, assets under management, but many are major investors. And it's common for the U.S. universities to have large endowments, but it is somewhat less common elsewhere in the world. Exhibit 11 shows the top 10 U.S. university endowments by assets and end of 2008 in terms of non-U.S. examples. University of Oxford, UK, and various colleges was estimated to have an endowment of 4.8 billion as of 2004. University of Cambridge, UK, has a 5.3 billion. These were by far the largest endowments in UK. The third largest is the University of Edinburgh with 156 million. The French Business School INSEAD's endowment is of 105 million. Okay, so here is the charitable foundations invest donations made to them for the purposes of funding grants and consistent with the charitable foundation's objectives. Similar to university endowments, many charitable foundations are sustained investors. Exhibit 12 lists U.S. grant-making foundation ranked by the market value of their assets based on the most current audited financial data in the Foundation Center's database as of 5th of February 2009. Again, a large foundation are most common in U.S., but they also exist elsewhere. For example, the Wellcome Trust in UK is a medical charity that had approximately 13 billion of assets in 2008. The Li Ka-shun Foundation in Hong Kong's based education and medical charity with grants, sponsorship, and commitments amounting at 10.7 billion Hong Kong dollars. A typical investment objective of endowment or a foundation is to maintain the real inflated adjusted capital value for the fund while generating income to fund the objectives of the institution. Most foundations and endowments are established with the intent of having perpetual lives. Example 1 describes that 22 billion Yale University endowment approach to balancing short-term spending needs with ensuring that future generations also benefit from the endowment. And it also shows the 13 billion Wellcome Trust approach. The investment approach undertaken considers the objectives and constraints of the institution. Banks typically accept deposits with and extend loans. In some cases, banks need to invest their excessive reserves. The investments of excess reserves need to be conservative, emphasizing fixed income and money market instruments rather than equities and other riskier assets. In some countries, including U.S., there are legal restrictions on banks owning equity investments. In addition to low risk, the investments also need to be relatively liquid so that they can be sold quickly for depositors wishing to withdraw their funds. The bank's objective is to earn a return on the reserves that exceeds the rate of interest and pays on its deposits. Insurance companies reserve premiums for the policies they write, and they need to invest these premiums in a manner that will allow them to pay claims. Similar to banks, such investors need to be relatively conservative, given the necessity to pay claims when due. Life insurance companies and non-life insurance companies differ in their purpose and objectives, and hence in their investment time horizon. Life insurance companies have longer time horizons than non-life insurance companies as a result of different expectations of when payments will be required under policies. Investment companies that manage mutual funds are also institutional investors. The mutual fund is a collective financial institution in which investors pour their capital to have it invested by a professional manager. The investors own shares or units in the funds. For many investment managers, the mutual fund is, in fact, their client. However, mutual funds are slightly different in that they can also be considered a financial product. For many individual investors, the mutual fund is the most efficient means to benefit from portfolio diversification and the skill of professional managers. The mutual fund is likely to invest in a particular category of investments, such as U.S. small capitalization equity. Mutual funds may also have certain limits and restrictions that apply to their investments, either as set by regulation or law, or as decided by the board of directors or of an investment company. We will revisit this investment vehicle in greater detail when we discuss pooled investment section 5. Sovereign wealth funds, the sovereign wealth fund SWFs, are government-owned investment funds of which many are very sizable. Exhibit 13 provides a list of top 10 sovereign wealth funds as of March 2018. So Norway, the People's Republic of China, Abu Dhabi, UAE, Kuwait, Saudi Arabia, People's Republic of China again, Singapore, quite large, Qatar, and People's Republic of China again. Some of this fund have established to invest revenues for finite natural resources, e.g. oil, for the benefit of future generations of citizens, other managed foreign exchange, or other assets of the state. Some funds are quite transparent in nature, disclosing their investment returns and their investment holdings, whereas relatively little is known about the investment operations of others. Exhibit 14 summarizes how investment needs vary across client groups. In some cases, generalization are possible. In other cases, it varies by client. Steps in the portfolio management process. In the previous section, we discussed the different types of investment management, clients, and distinctive characteristics and needs of each. The following step in the investment process are critical in the establishment of management of a client's investment portfolio. The planning step, understand the client's needs, preparations of an investment policy statement. The execution step, asset allocation, security analysis, portfolio construction. The feedback step, portfolio monitoring and rebalancing, portfolio performance management and reporting. Step 1, the planning step. The first step in investment process is to understand the client's needs and develop an investment policy statement. The IPS, a portfolio manager, is unlikely to achieve appropriate results for a client without prior understanding of the client's needs. The IPS is a written planning document that describes the client's investment objectives and the constraints that apply to the client's portfolio. The IPS may state a benchmark, such as the particular rate of return or the performance of a particular market index that can be used to in the feedback stage to assess the performance of the investments and whether objectives have been met. The IPS should be reviewed and updated regularly. Step 2, the execution step. The next step of the portfolio manager is to construct a suitable portfolio based on the IPS of the client. The portfolio execution step consists of first deciding a target asset allocation, which determines the weighting of asset classes to be included in the portfolio. The step is followed by analysis, selection, and purchase of individual investment securities. Asset allocation, the next step in the process is to assess the risk and return characteristics of the available investments. The analyst forms economic and capital market expectations that can be used to form a proposed allocation of asset classes suitable to the client. Decisions that need to be made in the asset allocation of the portfolio include the distribution between equities, fixed income securities, and cash, sub-asset classes such as corporate and government bonds, and geographical weightings within asset classes. Alternative assets such as real estate, commodities, hedge funds, and private equity may also be included. Economists and market strategists may set on the top-down view on economic conditions and broad market trends. The returns on various asset classes are likely to be affected by economic conditions. For example, equities may do well when economic growth has been unexpectedly strong, whereas bonds may do poorly if inflation increases. The economists and strategists will attempt to forecast these conditions. Security analysis. The top-down view can be combined with a bottom-up insight of security analysis, who are responsible for identifying attractive investments in particular market sectors. They will use their detailed knowledge of the companies and industries they cover to assess the expected levels of risk and of the cash flows that each security will produce. This knowledge allows the analyst to assign a valuation of the security and identify preferred investments. A portfolio construction, the portfolio manager will then construct a portfolio taking account of the target asset allocation, security analysis, and the client's requirements as set out in the IPS. Key objectives will be to achieve the benefits of diversification. Decisions need to be taken on asset classes weightings, sector weightings within an asset class, and the selection of the weightings of individual securities or assets. The relative importance of the decisions on portfolio performance depends on, at least in part, on the investment strategy selected. For example, consider an investor that actively adjusts asset sector weights in relation to forecasts of sector performance. The asset allocation decisions is commonly viewed as having a greatest impact. Exhibit 15 shows the broad portfolio weights of the endowment fund of Yale University, University of Virginia in 2008. As you can see, our portfolios have a heavy emphasis on such alternative assets as hedge funds, private equity, and real estate. Yale University, particularly so. Risk management is an important part of the portfolio construction process. The client's risk tolerance will be set out in IPS, and the portfolio manager must make sure the portfolio is consistent with that. As noted above, the manager will take a diversified portfolio perspective. What is important to note is not that a risk is of any single investment, but rather how all the investment perform in the portfolio. The endowment shows above how are relatively risk-tolerant investors. Contrast the asset allocation of the endowment funds with the portfolio mix of insurance companies shown in Exhibit 12. You will notice that the majority of the insurance assets are invested in fixed income investments, typically of high quality. Note that the Yale University portfolio has only 4% invested in fixed income, with the remainder invested in such growth assets as equity, real estate, and hedge funds. Its allocation is a sharp contrast to Massachusetts Mutual Life Insurance Company, or Mass Mutual portfolio, which has over 80% invested in bonds, mortgages, loans, and cash, reflecting the different risk tolerance and constraints. The portfolio construction phase also involves trading. Once the portfolio manager has decided which securities to buy and which and what amounts the securities must be purchased. In many investment firms, the portfolio managers will pass the trades to a buy-side trader, a colleague who specializes in securities trading, who will contact a stockbroker or dealer to have the trades executed. A buy-side firm, a broker or dealer that sells securities to the providers, independent investment research recommendations, and investment management companies. A buy-side firm is an investment managing company and other investors that use the services of brokers or dealers. Step 3, feedback step. Finally, the feedback step assists the portfolio manager in rebalancing the portfolio due to the changes in, for example, the market conditions or the circumstances of the client. Portfolio monitoring and rebalancing. Once the portfolio has constructed, it needs to be monitored and reviewed on the composition. Revisited or revised as a security analysis changes, because the changes in security prices and changes in fundamental factors when securities and assets weightings have drifted from the intended levels as a result of market movements. Some rebalancing may be required. A portfolio may also need to be reinvested if it becomes apparent that client needs or circumstances have changed. Performance evaluation and reporting. Finally, performance of the portfolios must be evaluated, which will include assessing whether the client's objectives have been met. For example, if the investor wish to know whether the returns required have been achieved and how the portfolio has achieved relative to any benchmark that has been set. Analysis of performance may suggest that the client's objectives need to be reviewed and perhaps changes made to IPS, as we will discuss in the next section. There are numerous investment products that the clients can use to meet their investment needs. Many of these products are diversified portfolios that an investor can purchase. Pooled investments, the challenge faced by all investors in this finding the right set of investment products to meet their needs. Just as there are many different types of investment management clients, there is a diverse set of investment products available to investors. These vary from a simple brokerage account in which the individual creates her own portfolio by assembling individual securities to large institutions that hire individual portfolio managers for all or part of their investment management needs. Although the array of products is staggering, there are some general categories of pooled investment products that represent the full range of what is available. At the end of the mutual funds and exchange traded funds in which investors have participated with a small initial investment, at an other end of the hedge funds, the private equity funds, which might require a minimum investment of $1 million or more. In this context, the amount of funds that an individual or institution can commit to a particular product has a significant impact on which products are available. Exhibit 17 provides a general breakdown of what investment products are available to investors based on investable funds. Mutual funds, rather than assemble a portfolio of their own of their own individuals, investors, and institutions, can turn to a selection of management of their investment portfolios of third parties. An alternative is a mutual fund. The type of fund is commingled investment pools in which investors in the fund each have a pro rata claim on income and value of the fund. The value of a mutual fund is referred to as the net asset value and computed daily based on closing price of the securities in the portfolio. At the end of the third quarter of 2008, the investment company instituted reported over 48,000 mutual funds in over 22 countries with total net asset value of approximately $220 trillion. Exhibit 18 shows the breakthrough of mutual funds asset across the major regions of the world as of 2007. Mutual funds are one of the most important investment vehicles for individuals and institutions. The best way to understand how a mutual fund works is to consider a simple example. Suppose an investment firm wishes to start a mutual fund with a target amount of 10 million. It is able to reach the goal through investment from 5 individuals and 2 institutions. The investments of each of the following, based on 10 million US dollars of net asset value. The investment firm sets a total of 100,000 shares and initial value of $100 per share. The investment firm will appoint portfolio managers to be responsible for the investment US of $10 million. Going forward, the total value of the fund or net asset value will depend on the value of the assets in the portfolio. The fund can be set up as an open-end fund or closed-end fund. If it is an open-end fund, it will accept new investment money and issue additional shares and value equal to the net asset value of the fund at the time of the investment. For example, assume that at a later date, the net asset value of the fund increases to 12 million, and the new net asset value per share is $120. A new investor, F, wishes to invest 0.96 million in the fund. Yeah, so this is just an example. There are advantages and disadvantages to each type of fund. The open-end fund market structure market is easy to grow in size, but creates pressure on the portfolio managers to manage cash inflows and outflows. One consequence is the structure is to liquidate assets, and portfolio managers may not want to sell at the time to meet redemptions. Conversely, the inflows require finding new assets in which to invest. As such, open-end funds tend to be fully invested, but rather keep some cash for redemption, not covered by new investments. Closed-end funds do not have this problem, but they do have a limited ability to grow. Of the total asset value in the U.S. mutual funds at the end of 2008, approximately 2% were in the form of closed-end funds. Types of mutual funds: we have the money market funds, we have the bond market funds, we have the stock market funds, stock mutual funds. We have the hybrid / balanced funds. Other investment products, we have the ETFs or exchange traded funds. We have separately managed accounts. We have hedge funds, and then we have buyouts and venture capital funds. Okay, summary. In this reading, we have discussed how portfolio approach to investing could be preferable to simply investing in individual securities. The problem with focusing on individual securities is that the approach may lead the investors to putting all her eggs in one basket. So to say, portfolios provide important diversification benefits, allowing risks to be reduced without necessarily affecting the compromising returns. We have outlined the different investment needs of various type of individuals and institutional investors. Institutional clients include defined benefit pension plans, endowments, and foundations, bank insurance companies, investment companies, and sovereign wealth funds. Understanding the need of your client and creating an investment policy statement represents the first step of the portfolio management process. The steps are as followed by security analysis, portfolio construction, monitoring, and performance measurement stages. We also discussed the different types of investment products that investors use to create their portfolio. These range from mutual funds to exchange-traded funds, hedge funds, and private equity funds. Okay, so that is reading 38 done. I do hope my readings have been helpful, and I am so glad to be doing this section about portfolio management. I really like the portfolio management side. I think it's a really important topic within the CFA reading, and I hope to see you guys next time for reading 39, Portfolio Risk and Return Part 1. Okay, I'll see you guys there, and remember the course show notes, and notes are in the description below for an Amazon link. You just go to the link and you get the show notes. Without further ado, goodbye.